The top 8 REITs to buy for passive income. REITs are known for the steady dividend income and with the ability to grow a business at a high pace. But on the other side, they also come with more risk. The reason why I love REITs is because they bring in a decent amount of extra money every month, which I use to reinvest. In this video, I'm going to show you real quickly some fundamentals of these 8 REITs and why I think every dividend investor should know them. This is not a deep dive into these stocks, but just a quick peek with some major fundamentals, so please keep that in mind. And I'm also very excited to see what you guys think about these stocks, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So let's start this list with one of the most popular REITs out there, Realty Income. Realty Income Corporation, ticker symbol O, is a real estate investment trust that invests in freestanding single-tenant commercial properties in the US, Spain and the UK that are subject to triple-N leases. Realty Income is at $64 and is down roughly 10% on the 1-year chart, which is very interesting since the S&P 500 is down 16% on the 1-year chart. Realty Income is a $39 billion market cap company. And since we're analyzing REITs, I'm not using the PE ratio but the price to FFO, which is the best way to value a REIT. Realty Income has a price to FFO of 17.8, which is a bit on the high side. I would prefer 16 or lower, so it means you pay a small premium for this stock. Revenue is growing quite nice and steady, and it's growing quite a lot since the end of 2021. Profit margin is decreasing over the long run, but it has increased quite a bit in the short term. This is definitely something to keep your eye on. And now the good part, the dividends. Realty Income has a dividend yield of 4.65%. Annual payout is at $2.98 a share. The thing that investors love about the Realty Income dividends is that they pay you a monthly dividend instead of a quarterly dividend. The payout ratio displayed here isn't correct since it's a REIT. The actual payout ratio is at 82%, which is all fine by me. REITs usually have a payout ratio around 75%. They grew the dividends for 26 years in a row, which is quite impressive. The 5-year growth rate is at almost 4%, which isn't that spectacular for a REIT, but it's still pretty decent. The last part is about the price target. I'm using the Everythingmoney software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets. I fill in the different assumptions and I hit analyze. I'm only focusing on the discounted cash flow value since PE ratio isn't a reliable way of evaluating a REIT. We have a low price target of $55. We have a mid price target of $65, which is around the current stock price, and we have a high price target of $76. Realty Income is one of the most popular REITs and with reason. They have a solid monthly dividend and the business is growing at a high pace. For me, this stock is a great way of generating passive income. Next stock on this list is STAG Industrial. STAG Industrial is a real estate investment trust focused on the acquisition and operation of industrial properties throughout the United States. Right now, STAG Industrial is at $33.5 and the stock is down 24% on the 1-year chart. STAG is a $6 billion market cap company and since we're analyzing REITs, I'm not using the PE ratio but the price to FFO, which is the best way to value a REIT. Price to FFO is at 15.4, which is really good in my opinion. This might indicate that they are undervalued. Revenue is growing really nice and steady and looks very good to me. Another thing that I really like is the fact that profit margin is increasing quite a lot over a longer period of time. STAG Industrial also pays a monthly dividend. Dividend yield is at 4.3% and annual payout is at $1.46. The payout ratio isn't correctly displayed here and it's at 67%, which is pretty good for a REIT. The 5-year growth rate isn't that spectacular, but they grew the dividends for 11 years in a row, which is pretty good. The last part is about the price target. I'm using the Everythingmoney software and I'm using a low, mid and high assumption to get the 3 price targets. I fill in the different assumptions and I hit analyze. I'm only focusing on the discounted cash flow value, since PE ratio isn't a reliable way of evaluating a REIT. We have a low price target of $25. We have a mid price target of $32, which is around the current stock price, and we have a high price target of $40. STAG Industrial is one of my favorite REITs and a great way of generating passive income. Dividends are looking really good and they pay you a monthly dividend. The business itself is growing at high amounts and there's plenty of room to grow in the industrial real estate industry. So for me, STAG Industrial is a buy. Next stock on this list is WP Carey, ticker symbol WPC. WP Carey is one of the largest net lease REITs, specializing in sale-leasebacks, build-to-suits and the acquisition of existing net leases. The stock is nearly flat on the 1-year chart, which is quite interesting since the S&P 500 is down 16% on the 1-year chart. WPC is a 16.3 billion market cap company with a price to FFO of 14.3, which could indicate that they are undervalued. Revenue is going up and down quite a bit, but in the long run it's up, which is the most important here. It's the same story with the profit margin. It's going up and down quite a bit, so definitely keep an eye on this number. Dividend yield is sitting at 5.3%, which is pretty high and brings in a decent amount of money. Annual payout is at $4.26. Payout ratio isn't correctly displayed here and sits at 75%, which is the average for REITs. The 5-year growth rate is quite low, but they did grow the dividends for 9 years in a row, which is pretty impressive. The last part is about the price target. I'm using the Everythingmoney software. I'm using a low, mid and high assumption to get the 3 price targets. I fill in the different assumptions and I hit analyze. I'm only focusing on the discounted cash flow value since PE ratio isn't a reliable way of evaluating a REIT. We have a low price target of $68. We have a mid price target of $80, which is around the current stock price, and we have a high price target of $87. WPC Carey is a decent company with some great potential. Dividends are looking great and the valuation is also quite interesting. Right now I don't own any shares of WPC, but they are on my watch list. Next stock on this list is National Retail Properties, ticker symbol NNN. National Retail Properties is a real estate investment trust that invests primarily in high-quality properties that are subject to long-term triple-N leases. The stock is down only 1%, which is quite interesting since the S&P 500 is down 16% on the 1-year chart. National Retail Properties is an 8.25 billion market cap company with a price to FFO of 15.47, which could indicate that they are undervalued. Revenue is increasing quite nice and steady, so this looks really good to me. Margins are also looking quite good, so this comforts me quite a lot. Both are increasing very nice and steady. Dividend yield sits at 4.7%, which is pretty high. Annual payout is at $2.2 and the payout ratio is at only 73%, which is the average for REITs, so this looks all good to me. The payout ratio displayed here isn't correct. The 5-year growth rate is at 3%, which is also pretty decent for a REIT. They grew the dividends for 32 years in a row, which is really impressive. The last part is about the price target. I'm using the Everythingmoney software and I'm using a low, mid and high assumption to get the 3 price targets. I fill in the different assumptions and I hit analyze. I'm only focusing on the discounted cash flow value since PE ratio isn't a reliable way of evaluating a REIT. We have a low price target of $42, which is just below the current stock price. We have a mid price target of $52 and we have a high price target of $64. National Retail Properties isn't in my portfolio right now, but I do have them on my watch list. It's a great stock with a proven dividend track record. They know how to keep things going, but I don't expect double-digit growth numbers in the future for this company. It's a steady but slow-growing company. Medical Properties Trust, the next stock on this list, ticker symbol MPW. This is a real estate investment trust that invests in healthcare facilities subject to triple-N leases. The stock is down 47% on the 1-year chart, which is of course a big drop. However, at current prices this might be an interesting one. MPW is a 7.4 billion market cap company with a price to FFO of 7.27, which is of course very low and could indicate that they are undervalued. Revenue is growing pretty decent historically, but of course during the lockdown periods revenue went up big time. Most recently growth started to slow down a bit, so this is something to keep your eye on. Margins are increasing most recently, which is also something that I really like of course. Medical Properties Trust pays a juicy 9.3% dividend yield, which is of course very high. Annual payout is at $1.16 and payout ratio displayed here isn't correct. The current payout ratio is 68%, which is still below the average for REITs, so this looks quite good. The 5-year growth rate is at almost 4%, which is pretty decent for a REIT, and they grew the dividends for 10 years in a row, which is also pretty impressive. The last part is about the price target. I'm using the Everythingmoney software, and I'm using a low, mid and high assumption to get the 3 price targets. I fill in the different assumptions and I hit analyze. I'm only focusing on the discounted cash flow value since PE ratio isn't a reliable way of evaluating a REIT. We have a low price target of $11, which is just below the current stock price. We have a mid price target of $14.8 and we have a high price target of $19.7. MPW was beaten down quite a lot in stock price in the past year. Dividend yield is really high at almost 10%, but payout ratio is below the average for REITs, so these things look really good to me. However, revenue started to slow down, so I'm really interested to see how this company will perform in 2023. For now, I think we need to wait with this one. I don't have any shares right now, but I will do a full analysis very soon. Next stock on this list is Agree Realty, ticker symbol ADC, one of the industry leaders in the acquisition and development of properties net leased to foremost retailers in the US. This stock is up 2.5% in the past year, which is quite interesting since the S&P 500 is down 16%. ADC is a 5.6 billion market cap company with a price to FFO of 16.4, which could mean you pay a small premium for this stock. Revenue is increasing really nice and steady, so this looks pretty good to me. However, margins are decreasing over a longer period of time, which is something that I don't like, of course, so definitely keep an eye on this number. Right now, dividend yield is sitting at 4% and they pay you an annual dividend of $2.88. ADC doesn't pay a quarterly dividend but a monthly dividend, so that's also very interesting. The payout ratio displayed here isn't correct. Right now, the payout ratio is at 67%, which is below the average for REITs. The 5-year growth rate is at 6.7%, which is pretty good for a REIT, and they grew the dividends for 10 years in a row. Overall, a great looking dividend scorecard. The last part is about the price target. I'm using the Everythingmoney software and I'm using a low, mid and high assumption to get the 3 price targets. I fill in the different assumptions and I hit analyze. I'm only focusing on the discounted cash flow value since PE ratio isn't a reliable way of evaluating a REIT. We have a low price target of 63, which is right below the current stock price. We have a mid price target of $78 and we have a high price target of $96. ADC is one of the most recently added positions in my portfolio, and with reason. I really like the business and the fundamentals of this stock. There's plenty of room to grow and dividends are looking great. However, margins are something to keep your eye on. For now, I'm slowly adding more shares to my portfolio. Next stock on this list is Crown Castle, ticker symbol CCI. Crown Castle is a real estate investment trust and provider of shared communications infrastructure in the US. Its networks includes over 40,000 cell towers, approximately 85 route miles of fiber supporting smart cells and fiber solutions. This stock is down almost 24% on the 1-year chart, which is quite a lot. CCI is a 63 billion market cap company with a price to FFO of almost 19, which means you pay a premium for this stock. Revenue is increasing quite nice and steady, which is something that I really like, of course. And margins are increasing quite nice and steady as well, so this is something that really comforts me a lot. Dividend yield sits at 4.3% and CCI pays you an annual dividend of $6.26 a share. Payout ratio displayed here isn't correct and the correct payout ratio is at 81%, which is just above the REIT's average. The 5-year growth rate is at almost 9%, which is really high for a REIT, so that's looking quite good. They grew the dividends for 8 years in a row, which is also pretty impressive. The last part is about the price target. I'm using the Everythingmoney software and I'm using a low, mid and high assumption to get the 3 price targets. I fill in the different assumptions and I hit analyze. I'm only focusing on the discounted cash flow value since PE ratio isn't a reliable way of evaluating a REIT. We have a low price target of $60, which is a big drop from the current stock price. We have a mid price target of $76, which is still a big drop, and we have a high price target of $89. So according to these assumptions, the stock is massively overvalued. I really like the business and the industry that they are focusing on. The fundamentals also look really good, and it's the same story with the dividends. However, the valuation is quite interesting to say the least. According to the price target tool, the stock is massively overvalued. Right now I don't own any shares of this stock, but they are on my watch list and I can't wait for the stock price to come down since I really like this business. Last stock on this list is Public Storage, ticker symbol PSA. This is an American international self-storage company that is run as a real estate investment trust. It is the largest brand of self-storage services in the US. The stock is down 23%, which is quite a lot compared to the S&P 500, which is down 16%. PSA is a 48 billion market cap company with a price to FFO of 9.38, which could indicate that they are undervalued. Revenue is growing really nice and steady, but since 2020 it really took off because of the lockdown periods. Another thing that I really like is the fact that margins are increasing, also really nice and steady in the long run. Current dividend yield is at 2.89% and annual payout is at $8. Payout ratio isn't correctly displayed and sits at 30%, which is quite unusual for a REIT. They have no growth in dividend because since 2016 it's at $2 a quarter and has never increased since then. So this is something that I really don't like, of course. The last part is about the price target, and I'm using the Everythingmoney software, and I'm using a low, mid and high assumption to get the 3 price targets. I fill in the different assumptions and I hit analyze. I'm only focusing on the discounted cash flow value since PE ratio isn't a reliable way of evaluating a REIT. We have a low price target of $211, which is a big drop from the current stock price. We have a mid-price target of $278, which is right around the current stock price, and we have a high price target of $366. I really like the business and the stock seems very interesting at current valuations. However, I don't like the dividend growth. To me, this is also very important when it comes down to passive income. It needs to increase in ratio over time. Other than that, this is a great stock in my opinion. I don't have any shares of PSA right now, but they are still on my watch list. And this was the full list of 8 REITs for passive income. I really enjoyed creating this list and I will try to do more of these top 5, 8 or 10 stocks since they can be a great starting point of choosing the right stock to buy. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did some insights of the companies to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.